Have you ever wondered how Canada's real estate market is set to evolve by 2025, especially in the multifamily sector? Well, you're in the right place to gain some insights today. Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. According to a recent report by CBRE, Canada is at an inflection point politically, economically, and socially. Despite these challenges, the country remains a robust growth play. Among the G7 nations, Canada is projected to lead in gross domestic product, population, and employment growth over the next 5 years, which is highly correlated with demand for all types of commercial real estate, including multifamily properties. The year 2025 is expected to be a year of increased activity in the real estate market. The cost of capital crisis is anticipated to ease, leading to a boost in both investment and leasing activities, contingent on global bond market conditions. Leasing fundamentals are improving, although Canada has seen a significant influx of new supply in the office, industrial, and residential sectors, which will take some time to absorb. Specifically focusing on the multifamily sector, the report highlights that although immigration curbs and new supply deliveries have created some uncertainties in the near term, the long-term growth fundamentals remain solid. This presents a compelling investment thesis for those considering multifamily real estate. In terms of the broader economic outlook, Canada's longer-term prospects remain favorable compared to its Group of Seven counterparts, even with modestly lower economic growth forecasts due to immigration restrictions. This is good news for commercial real estate demand, particularly in the multifamily sector. The industrial sector, on the other hand, is facing some headwinds with softer demand and an influx of new supply. However, the market is expected to work towards normalization sooner than some might expect, which is optimistic news for investors. Overall, the positive sentiment in the capital markets is expected to lead to stronger investment activity in 2025. Capital currently on the sidelines is likely to be drawn back into the market, with cap rates for certain asset classes starting to compress, albeit subject to global bond market conditions. So why is real estate becoming the go-to retirement strategy for Canadians? Well, as reported by Michelle Kellett on December 12, 2025, in the article titled Why Canadians Use Real Estate for Retirement, real estate has become the de facto retirement strategy for many Canadians. Statistics. Canada shows that over 52% of Canadian household wealth is held in real estate, making it the largest retirement asset for most families. More than $6.4 trillion in real estate assets are held by Canadian households, far surpassing investments in equities or pensions. With higher home ownership rates than participation in private pension plans, property has become the dominant vehicle for building retirement wealth. This is especially true in Manitoba, where accessible price-to-income ratios have allowed residents to enter the market earlier, providing more years to build equity. Canadians typically rely on real estate for retirement in four primary ways: mortgage paydown as forced savings, appreciation over time, rental income generation, and downsizing or liquidation. Manitoba's stable rent rates and lower carrying costs make it an attractive province for those looking to generate rental income. So, what are the roots of Canada's reliance on real estate? Decades of policy, demographic pressure, and cultural norms have played a role. Post-war housing programs facilitated home ownership expansion, while population growth consistently exceeded new housing supply. Culturally, home ownership has been seen as a marker of stability, making real estate a cornerstone of Canadian wealth. However, there are risks involved in relying heavily on real estate for retirement. Market volatility, lack of liquidity, overconcentration of wealth, and unexpected expenses can pose challenges. It's crucial for Canadians to consider diversification in their retirement planning. Interestingly, the Canadian approach to retirement contrasts with the United States, where a higher proportion of retirement savings is held in structured financial vehicles like 401ks and IRAs. In Canada, the retirement wealth is more tied to home equity, making it more susceptible to housing market shifts. Looking ahead, analysts anticipate continued long-term demand growth in the Canadian real estate market due to population increases, even with slower short-term price appreciation. Manitoba is emerging as a strong market for those seeking balanced real estate-based retirement planning with its lower volatility and favorable demographics. For those considering investment properties as part of their retirement strategy, partnering with a property management firm can be a game changer. Professional managers handle tenant screening, maintenance, and compliance, allowing investors to focus on their long-term strategy without the operational workload. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.